Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Francis Donald of RBC writing US tariffs in the size that they have been floated, or even a fraction of that size, could filter into the Canadian economy immediately, significantly, and then persistently for many years. Francis joins us now for more. And Francis, maybe we've avoided them. Maybe they happen in 1 month's time. I don't know. But what I'd love to hear from you is the price of the uncertainty. What is the price that we have to pay?
Well, even though this trade shock that we look to have avoided would have been the largest in 100 years for the North American economy, we do have some things that we know about tariffs and the threat of tariffs from the 2018-2019 experiences. And one of them is even just the existence that they may occur has historically stalled business investment, household decisions. It creates an uncertainty tax on the entirety of these economies as businesses lack clarity on what will happen next. So it wouldn't surprise me if we see a pause in business activity, a hit to business confidence in the United States, Canada, and in other countries. And we see this distorting more of the Q1 data on top of a period which historically we have a lot of trouble understanding the data from for seasonally adjusted reasons.
Francis, the way that John put it earlier was some anti-growth measures were being floated and dealt with now by Donald Trump, and later there'll be the pro-growth measures. Are these hits to potential growth easily offset with tax cuts and some of the other proposals?
We haven't been able to make the math work on tariff revenue matching tax cut needs. But what's really critical here, and Lisa, I think you nailed it, is the sequence of these events. Trade shocks, tariffs, they're stagflationary. We know that to be true. They limit growth. They create inflation, but then you might see, for example, tax cuts that come through, deregulation. That tends to be pro-growth, pro-inflation. And I think what's key here is that almost all of the policies that we've heard floated from Washington do have an inflationary element. But markets will care less about that, and the U.S. will be able to absorb more of that inflation if it comes with a side of growth. And that's why I think you're seeing a lot more concern about the inflationary elements of tariffs than you are, for example, the inflationary elements of corporate tax cuts. Now, underlying the surface, Lisa, I think the real inflationary story, and the one that should be concerning us most of all, is that the U.S. lacks workers, not jobs. It is heading into a period where it's going to experience real demographic challenges. We expect the labor force participation rate to decline in 2025. We have the least amount of workers ever working in the United States right now, the most amount of retirees. If we see a change to immigration policy, in fact, we're already seeing some of that, we're going to see more challenges to labor supply. That's going to be the most nefarious form of inflation as it pushes up wages, good, but flows through the economy more broadly. So inflation is one word, but there's all different types of inflation, and all these policies carry different variations of good inflation and bad inflation.
Francis, there's so much uncertainty that Fed officials are saying very little, and a lot of people are cheering that and saying nobody knows. Have you seen enough to change your outlook for the year when it comes to growth, when it comes to inflation in the United States?
Well, we were prepared to downgrade our U.S. growth forecast if we had seen those 25% tariffs on Canada and Mexico come through. Those would have shocked U.S. growth by a full percentage point in 2025 and lifted inflation by half. As of right now, there's not enough, even with the Chinese tariffs, to really make a meaningful change in that outlook. But our U.S. rate strategist, Blake Gwynn, has a really good line. He says the Fed is going to be watchful, not reactive. Of course, the Fed is filled with a lot of economists, and I think economists on the street are going to be doing something very similar to that.
How much has changed, Francis, in the last 3 months? I was listening to some comments from the Chicago Fed President, Austin Goolsbee. They seem out of sync with what I heard from him at the end of last year, that's for sure, before Trump got into power. We've got to be more careful with how fast to cut rates. What has changed for them?
Well, we may feel a huge sense of relief over the news from the past 24 hours, but remember this massive trade shock, and I got to be clear here, this trade shock, 25% tariffs on Mexico and China, would have brought the average import tariff for Americans up to almost 11%. It currently sits at 3%. It's a quadrupling of the trade pressure that would exist within the U.S. economy. It didn't disappear. It's been paused for 1 month. We still have the April 1st America First trade policy negotiations. We have USMCA being negotiated. We're hearing a lot of chatter about European tariffs, and then we have Chinese tariffs that came on. That, as you mentioned at the start of this segment, is still a massive economic shock, and it would have to have you reevaluate how you're looking at the economy in 2025, especially if you're a central banker. Because if you're a central banker in that situation, you're having to model growth down, inflation up. Some central banks only have an inflation target. This central bank has a dual mandate, and those mandates would go in the opposite direction.
A rock and a hard place, and somewhere in between. Francis, appreciate your time as always. Francis Donald there of RBC. Sarah Hunt of Alpine Saxon Woods joins us now for more. If all of Wall Street's horses and all of Wall Street's men can't put the globalized economy back together again, how do we think about where best to allocate assets? What a question. Sarah joins us now for more. Sarah, good morning.
Good morning.
I'm going to talk about red wine from Napa. As much as I'd love to. Let's talk about this. The policy mix that we're going to see from this administration. Does it attract capital or push it away?
I think that that's the million-dollar question right now, and it's certainly something that's been talked about for the first week in a way that it wasn't talked about in the first Trump 1.0, right? There wasn't an argument about capital then, and I think that what we're going to see is what we've seen so far, which is, going this way, going that way. There's going to be a zigzag back and forth, and I think it is hard to pin those things down. So I don't know what the answer is yet, but the big fear is that it does have a negative effect on capital.
The consensus view seems to be that this is still a pro-growth administration, that it will attract capital. The S&P 500 is still around 6,000, but there has been some damage done, particularly to the automakers. How investable do you think certain industries are with this cloud hanging over them?
Well, the tough thing for the automakers is that that's a tough industry anyway because it's so capital intensive and things change so fast. So I think that there is, you obviously have seen on the semiconductor side, those stocks have not really recovered, even though the market seemed to recover some of the issues from the DeepSeek. So I think that there's a variety of different things going on at the moment, and people will start to have more enthusiasms or less either for different sectors or different areas. But I think that this adding into the tariff thing absolutely puts, a little bit more of a question mark on going too deep into anything without recognizing that there's possible issues that are coming.
We started the show with Steve Chivarone of Federated, and he came on and he does his typical Monday morning, although it is Tuesday morning. He did his typical, look, just hold your horses, look at the fundamentals. There are a lot of good things going on out there, and he's generally bullish, and he's looking to buy on the dips, whether it's semiconductors or some of these other spaces that have been disrupted by tariffs. At what point do you agree with that?
Well, I think that there have been already areas where you have reasonably good value. The discussion prior to a lot of this was that the S&P equal weight was going to start to catch up to the S&P because the S&P was so heavy in those top Mag 7 names. And so I think that there are areas where you can look at the valuations and go, this is completely reasonable. You look at things like some of the materials, some of the food stocks have gotten absolutely crushed. There are a couple of different things that we like in that area that have good dividend yields and reasonable valuations, 10, 13, 14 times earnings. That's not crazy given where the S&P is right now. So there are obviously areas that you can look at, but it is definitely more of a nimbleness, and you have to be watching things much more closely.
We've seen the NASDAQ underperform pretty considerably, and tech stocks in general for the past more than a month, actually. As you mentioned, they really haven't recovered. At the same time that you have seen this broadening out, yesterday was instructive in terms of what stocks would get most beaten up as some of the trade tensions really picked up. It was the small caps. So how much does the tariff talk threaten the broadening out that a lot of people have been hoping for?
Well, I think that yes, you're going to get those reactions, and then you have to see where that data comes in. And your discussion earlier about the Fed, to the extent that they may not want to do anything, this sort of gives them cover not to do very much for some period of time as they sort out what's going on. It really is going to depend on where the economic data go, and that's going to matter for the small caps enormously, as well as interest rates. And I think that right now is one of those vulnerabilities that's an economically sensitive area. Not that the rest of the market isn't economically sensitive, but it's more so, and it's more attuned to what's going on in the U.S. economy. So I think for those companies, what really matters is how things are going on the earnings and the economic front.
At that point, there's a real important message coming from the bond market yesterday, where we didn't see a huge rally in the 10-year yield. We didn't see a huge sell-off either from some of the inflationary impacts of potential inflationary impacts of tariffs. What was the message to you? Was there one, or was it just people paralyzed because they had no idea how to game it out?
I think yesterday was, it's interesting because I think that yesterday the equity markets obviously had a big reaction in the morning, but I think that there was some of a wait and see attitude about where is this really going to go by the end of the day? Because we know that there is the possibility, I'm having phone calls, so that's telling you there's a possibility for this not to be as harsh as it sounds at the get-go. So I think that on the bond market, people were more waiting to go, we're not really sure which way this is going to go. And it's until, if it had gone through to today and nothing had changed yesterday, I think you would have seen a bigger reaction. But I think because that reaction was muted within the same day it changed, I think that gave people enough time to go, it's okay, we can wait before we make any major decisions.
I won't debate how much moved, but I think on this stress test, I think we could take something away directionally from what happened. The fact that yields dropped back at the long end and didn't rise. There's something to be said there. BMO's Ian Lincoln made that point. We discussed it earlier. There's certain parts of this market, certain investors have begun to talk about the growth risk associated with tariffs and not exclusively the inflation risk.
And Francis, Donald mentioned that it would take about 1% off growth in the U.S. if some of these tariffs had gone into effect. I think you're right. On the long end, the fact that you saw a yield curve flattening, it shows that people have a very clear sense of what kind of disinflationary hit it could have over the long term.
I don't know what these tariffs would do. We've talked about this repeatedly. By definition, the importer pays the tariff. How the cost gets distributed is going to depend on what the goods are. I know this, though. You can't replace Ferrari. Ferrari coming out with earnings moments ago.
Oh, boy.
OK?
Oh, boy.
Sales rising 14%. 1 in 4 vehicles sold, guess where? In the United States. The stock is up this morning by a little more than 3%.
You can't replace Ferrari, but some of us can't afford it. So it would be really nice to, share it once in a while. Let me have the keys. It's like, obviously, you can enjoy it. I can't.
Not many people can afford Opus One either, Bravo.
I know. But, it's sort of the perception is, that it's a really wonderful car. And I just wonder if any of this will dent that perception.
Yes, agreed. Good to see you, Sarah. Thank you. As always, Sarah Hunt there of Alpine, Saxon Woods. George Saravelos of Deutsche Bank saying euro-dollar is at risk of parity, writing the drivers of euro-dollar can be broken down into two parts, relative monetary policy and a tariff risk premium. George joins us now for more. George, welcome to the program. Let's talk about the second part, that tariff risk premium. How big is that?
So, John, I think it's the key question for the next few months. And on our end, we're not spending much time trying to predict what President Trump will do. I think the experience of the last few days has shown it's not a very fruitful exercise. It's all about trying to figure out what the market's pricing and therefore the risk distribution around events. And when we look at the so-called tariff risk premium, and you can see it in many different parts of the market, you can see it in the US inflation curve, you can see it in the deviation of the dollar from fair value, you can even see it in what's known as the EFP in COMEX futures for gold. When we look at all these tariff metrics, they've been sending a consistent message that the market's pricing a very limited tariff risk premium. It again tried to price more yesterday. It's now reverted back. But it's precisely because that tariff premium is still quite low that we see the risk distribution skewed towards essentially pricing in more tariffs if and when they materialize.
George, is that just the euro, or can you say the same thing about the Chinese currency?
I would say it's across the board. If you're looking at all global markets, whether you're looking at fixed income and the so-called inflation hump that's priced into break-evens, it is still, that inflation hump is still very low. It is definitely valid for the dollar. When you're looking at the euro, for example, when we mention parity, that is not a forecast, so to speak, that's set in stone. It's just that if you get a reasonable outcome in terms of tariffs around the midpoint of the range that's been discussed, that's where we'd get to. Of course, if you get even worse outcomes, it could be bigger. China is more difficult because this is a policy-determined currency. The market is not free-floating. And I think this one is where the specific policy choices by the authorities will play a much bigger role.
George, you talk about the trade war risk premium, and that typically has been strong dollar. We've been talking on the show about at what point the hangover effect of the tit for tat of trade negotiations, trade wars, ends up with the rest of the world trying to withdraw money from the United States, not put money into the United States. How much and how closely are you watching? What indicators to maybe suggest that the appetite for the dollar was starting to wane?
That's a great question, and I think a very important one. So the way we think about it, first of all, is relative economic impact. You have to think about currencies in that way. And the US possesses a number of unique features. It's the world's largest economy. It has the lowest share of trade. It has a big trade deficit, and it's very services intensive. And President Trump, of course, knows all these things. But what that means is that every time tariffs are threatened, it has an asymmetric impact on the rest of the world, and that's exactly why the dollar is strengthening. I think what you would need to see for an unraveling of the inflows you allude to is essentially a big US-centric growth slowdown that's more sharp than the rest of the world, that causes the Fed to become more dovish. And so far, especially given that tariffs are tied in with the fiscal negotiations potentially in a fiscal expansion, we don't see any signs of that.
In the meantime, there is the likelihood, as you said, the disproportionate effect in other countries, that if tariffs do go into effect, or even the suggestion of them will slow economies like Canada, we heard that from the Bank of Canada, or potentially in the European Union on the margins, even though this is a single mandate ECB, do you expect them to cut rates more aggressively to counteract some of that potential growth shock?
Well, again, the ECB is a huge focus. And to go back to the point around the tariff risk premium that was priced in, up until last week, the market was pricing the ECB to stop above 2, around 2.1, 2.2. Now, if you think about that, that was at the upper end of the neutral range, which Lagarde alluded to, 225 to 175. So our view on the ECB has definitely been more dovish than market pricing. If you take a step back, European growth is below trend. Forward-looking numbers of inflation are pointing at or below trend. You've got a net fiscal stance that's tightening and tariff risks. So we see the ECB potentially cutting down to 150. The market has adjusted over the last few days, but I think, especially versus the Fed, we see that rate differential widening again.
So, George, when you say that, I just want to jump in. I'm surprised that that's even somewhat contrarian right now. It's surprising to me that ECB officials are still talking about neutral and not talking about getting accommodative. When's that going to change?
So it's a very interesting point you raised, John, because the narrative in the market is that the ECB should be cutting more. But I always like distinguishing between the narrative and what ultimately matters, which is pricing. And if you look at market pricing for the ECB, it has been fairly hawkish. It's been above 2. Why has that been the case? You have had some rise in energy prices, and the ECB is sensitive to that. But I think crucially it's ECB communication, especially from those hawkish members, for example, Governing Council member Schnabel. And I think what is required to change is for these members to gradually accept that the ECB is going to need more, to do more, and I think we will get that over the next few months.
Hey, George, clinic from you as always, sir, on foreign exchange. Appreciate your time. George Saravelos there of Deutsche Bank. Let's turn to the auto industry. Dan Ives of Wedbush is not overly concerned about tariffs, writing, the supply chain can adjust to a near-term shock and weather the storm. If these tariffs stay in place for 30 to 60 days, we see minimal impact to GM and to Ford. Dan joins us now for more. Dan, good morning.
Great to be here.
30 days. If we got that in 30 days and they lasted 30 days, are we only saying there's only going to be like minimal damage? Does this not hold these companies back from making big decisions?
I think it's minimum. I mean, I'll be in Detroit, tomorrow. I think ultimately right now in terms of GM, Ford, it's very contained in terms of the impact. Now, I think when you look at Tesla, that's probably the one that's least impacted, especially given their supply chain. But our view is here, bark worse than the bite, whether it's on the auto side, and I continue to view on the China side, even on chips, even though that's pressuring names like NVIDIA and others. Just as we've navigated in 2018, 2019, you don't sell these stocks because of it, because I continue to view, just like you talk about, where's the spending? I think it's going to be another robust number from Google tonight. Saw Palantir and others. AI revolution alive and well. Tariffs are not impacting that in our view.
One of the reasons why your analysis is particularly special is not just because you've been right about a lot of it, but also you travel a lot. You talk to people. You see the sentiment. Has there been, even in the past couple days, any sort of shift in the optimism because of the uncertainty?
Yeah, I think less about like in terms of Mexico and what we're seeing in Canada. It's from a China tariff perspective combined with DeepSeek. I think there was just general, maybe a little more agita in terms of what that means in terms of U.S.-China cold tech war, tariffs, what the next step is. Because part of the issue is if you go back to this last week, Nadella doubles down $80 billion, Zuckerberg $65 billion. You see just massive capex tonight from Google, Palantir, and massive AI, just another phenomenal quarter. I think the worry is, could anything spoil the party? And the only thing that spoils the party is a ratcheting up in terms of U.S.-China tension. So I think in terms of the nervousness, that's why you're seeing pressure on NVIDIA, on overall tech here, as this plays out.
GM was supposed to be immune from this because they actually moved their operations and their business out of China largely to Mexico. Now they're in the crosshairs. I just wonder if other tech companies in particular are moving operations out of China more aggressively to immunize themselves from this type of shock.
Yeah, I mean, like to that, look, in GM, it's been sort of one punch after another from the EV perspective in terms of from one administration to the other, the Mexico situation. But I do believe, Mary and the team navigated that extremely well. And I think GM continues to be a stock that we're bullish on here. In terms on the China side, look, my view, we talk about if Apple decide today, if Tim Cook's like, we're going to move 10% of our supply chain out of China, that would basically take about 2 years and ultimately something that could cost, what I think 30, 40 billion if it ultimately, translated. The point is that it's always easier said than done, and I think that's the conundrum because the reality is like when you look at Apple, you look at Tesla, that's why Cook, Musk, 10% politician, 90% CEOs.
Let's talk about Elon Musk and the closeness to the administration. We've talked about the benefits of that closeness and what it could mean, the halo effect, as you've talked about, over Tesla. Foreign nations are starting to see this as a potential pressure point. We saw that from a Canadian province in the last 24 hours, threatening to cancel a Starlink contract. Is it a benefit or not?
Look, there are definitely offsets, as we've talked about, but the gold at the end of the rainbow is autonomous. I mean, autonomous, we think that that's worth $1 trillion in terms of that to the Tesla story. I think as you get a federal framework, and I think this is key in terms of the Trump administration, that's the path for growth in terms of what I view as generational growth for Tesla. So Musk, he's someone that's, look, he's not going to, ultimately peel back, right? So he's going to continue going in this direction. There's negatives, no doubt, but I just think the positives, it was a bet for the ages on Trump, and it continues to be that. And I think it's going to be a historical bet.
The president clearly wants to celebrate the national champions of American and corporate America, and so he should. So he should. Let's be clear about that. The question I'm asking is whether other countries begin to punish those national champions. We've seen that from the Europeans on tech. We've seen the tech players not even be able to get into China. Tesla's a rare one.
It's a very rare one. I mean, Tesla and Apple, you put on just a different perch because those, you talk about with Google, they have an operator in China. Who cares? China's actually, the only two tech companies, it's Tesla and it's Apple. And that's why that's the tightrope, right? Because for Musk, and that's also why even when it comes down to TikTok, and we continue to think Musk or Ellison is probably in the front runners in terms of what potentially is that asset sale. But for Elon right now, it's navigating this whole thing. But I continue to view him more entrenched in the Beltway, despite all the noise, is the best thing that ever happened to Tesla shareholders.
To your point, John, last month, Tesla sales fell 63% in France. That is because, in large part, people were taking a look at the political backdrop and saying, nuh-uh, this isn't our gig. I do wonder if there is some reputational damage being done in the longer term, where people are looking at what's going on, some of the tactics, and they're saying, let's look elsewhere. Are you seeing that in any capacity?
Look, I think it's contained in terms of the demand issues that maybe that Dave's seen from a negative perspective, because of it. But Lisa, I think the most important thing is when you think about autonomous, you think about robotics. I mean, that's really the Tesla story. I think 90% of the story today is about that. So there could definitely be some demand issues, we'll call it contained, but what the streets focus on, you saw it last week, right? Like the bears scratching their heads, like, why is this stock not not going down given numbers got lower, because the street is focused on autonomous robotics, and that ultimately, if you look where they are in the Trump administration, Musk is in a, he continues to play chess, others playing checkers relative to this situation.
One of the big arguments, especially as the China-U.S. trade war really heats up, or trade dance, whatever you want to call it, there is a question about whether it pushes China even more to develop a parallel tech sphere to the U.S. that becomes dominant in its own right, that might be more amenable to a number of countries around the world. How realistic is that to you? Does that become more of a possibility? I think it's not realistic just because of NVIDIA. I mean, we just continue at high scale GPUs in terms of true build outs. You need NVIDIA. There's one red phone that goes to Jensen. Now, obviously, DeepSeek, that was kind of the white knuckle moment. Everyone's like, does this change the whole narrative? And I think as more has come out about that, people realize, maybe the bark is a lot worse than the bite. Look, you'll have a decoupling in terms of what's happening in China and the U.S. But in negotiations, it's so important because, again, U.S. needs China, China needs U.S. And I think that's why it's very, very important, especially when it comes to chips, that this could be a decoupling but not get in the way of what I view as a generational tech environment in terms of, what we see with AI.
NVIDIA, monster run-up over the last few years. Got to say that up front. But 22% drawdown in the past few months. Why hasn't that stock recovered? We had a week, we worked out that DeepSeek is maybe not what people thought it was. And here we are, we're still rolling over. Why?
And I think that there's a few reasons. One, it's just like Microsoft has, Apple, they've sold even after, I think, better than feared numbers. I think there's worries just in general about, can they continue to sustain it? If any little thing happens flying the ointment, stock gets crushed. So you've seen a little bit of a risk off, but look, I just continue to view it 6-9 months from now. We look back at this as a golden buying opportunity, not the time where there's something structurally wrong and numbers don't.
Or we've just found better vehicles to play the theme, which is Palantir.
But to that point, that's why you look at again that's a. If you look at that Palantir quarter, they could print that press release off, put it in the Louvre in terms of just how strong it was. And it shows what they're doing in terms of Palantir is, I believe, one of the best plays in AI. But to your point, as the second, third derivatives take hold, from Google to Salesforce to others, there's going to be other ways to play. It's not just about Mag 7. There's going to be others that play into this.
Next to the Mona Lisa, untamed AI demand.
Yeah, right to the left. And then there's, I think that could be where.
It's just a QR code to an NFT.
Special VIP tickets, something like that.
Click on it.
It's 2025, man. Anything could happen.
Good to see you.
Yeah,
thanks for dropping by.
Thank you.
A lot to talk about in tech right now, that's for sure. Dan Ives of Wedbush there.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.